Today, November 26, Bitcoin has once again crossed back above the $90,000 level, an important psychological threshold it had lost for nearly a week. This move is especially noteworthy because it completely breaks with tradition. In 6 of the past 7 years, the Wednesday before Thanksgiving has delivered negative returns for Bitcoin, including severe drops in 2020 and 2021. Yet here we are, with BTC up almost 3% in the last 24 hours and roughly 12% from last Friday's brief panic low near $80,000. At the time of recording, Bitcoin is trading just above $90,000. That still leaves it down 3% on the week, 21% on the month, and approximately 28% below its all-time high near $126,000 recorded earlier this year. The price action itself looks bullish on the surface, especially in a week when volumes are traditionally light and volatility tends to compress. Jasper DeMare, desk strategist at Wintermute, described the current environment this way: Bitcoin volatility is rolling over since hitting the highest level since April this year as the market is trading on lower volumes during the week of Thanksgiving. Then markets can soften sharp swings. He went on to point out that options positioning is heavily skewed toward range-bound trading. The market looks comfortable fading moves on both sides rather than positioning for a breakout. In plain English, most professional traders are selling premium around the $85,000 to $90,000 zone and are not heavily protecting the downside, which suggests limited expectation of a violent move in either direction over the long weekend. So far, the price chart supports that view. But when we move from price to on-chain data, the picture becomes considerably more cautious. CryptoQuant data now shows that large Bitcoin deposits, meaning transfers of thousands of BTC from single wallet clusters, have climbed to roughly 45% of all hourly exchange inflows. That percentage has been rising steadily since early October. Historically, this pattern is associated with distribution by whales and institutions, not accumulation. At the same time, Glassnode's stablecoin flow metrics revealed that Tether, USDT, is leaving exchanges at one of the fastest rates in over a year. When stablecoins flow out, immediate buy-side liquidity shrinks. The rallies we saw earlier this year that took Bitcoin from $60,000 to $126,000 were accompanied by strong stablecoin inflows. November, by contrast, has been marked by persistent outflows, shown in deep red on the charts. In short, more Bitcoin is moving onto exchanges and positioning for potential sale, while fewer dollars in stablecoin form are sitting on those same exchanges ready to buy. That is the opposite liquidity profile of a healthy, sustainable uptrend. We have seen this movie before this month. $100,000 failed as support, then $95,000, then $90,000 itself, until today's reclaim. Without a clear reversal in these two critical flows, large BTC deposits declining and USDT inflows turning positive, the probability remains high that $90,000 will be tested again from above in the coming days or weeks. For now, the market is in a fragile equilibrium. The price may hold through the holiday on thin volume, but the underlying data is flashing yellow, possibly red. Bulls need to see concrete improvement in on-chain liquidity before declaring this anything more than a technical rebound in a broader downtrend. That's the current state of play. I'll continue monitoring these metrics closely and will update you as soon as meaningful changes appear. If you found this analysis useful, please consider giving the video a like, leaving a comment with your own view, and subscribing for daily market updates. Thank you for watching, and I'll see you in the next one.